Today on Pro Edgewire, I'm with John Embry. He's the Chief Investment Strategist for Sprott Asset Management. John, I want to talk to you about the presidential election. We all want to know how this is going to impact our pocketbooks.
Well, that's a good question, because before the first debate, I would have told you that it was a done deal. Obama was going to be reelected. Bernanke would probably be reappointed as Fed chairman. And we're going to have business as usual, which was going to be just more and more money creation and more deficits, because they don't really see an alternative. Now, Romney and Ryan at least look like sort of another animal. And they are talking in certain ways in a sort of austerity type mode, but not totally. I don't understand how Romney can say he's going to raise defense spending, cut taxes for virtually every segment of society, cut corporate taxes, not really tackle entitlements anytime soon. But we're going to take it all out of discretionary spending, which, when you look at it, isn't all that much. So I think what will happen if he is elected, and I think right now it's a toss-up, that the impact will be probably negative initially on markets, like anything that is dependent on QE or what have you, because the fear of the unknown will be there. But I think it will be relatively short-lived, because I think when he gets in there, he's going to find that the situation is sufficiently dire that you really don't have that much leeway to sort of cut, because the economy is barely moving forward today, and they've got about $1.3 trillion worth of deficit stimulus in there. Without the deficit, the thing would probably be in reverse to 5%. And with all the debt that's out there, I mean, that's just not going to happen voluntarily. They will not sort of cave the system in on their watch, unless it's an accident. So I think the initial reaction will be probably sober if Romney wins, but then I think we'll probably be back in the not too distant future to business as usual.
Okay, so what is going to happen specifically with the resource sector and public equities market in general? What do you expect to happen if Obama comes in? Do you expect things to continue to perhaps get better? We're not really sure what's going on. We would like you to tell us what you think.
Well, I don't think the economy is going to get better. I mean, I don't believe that quantitative easing, unlimited money creation, does anything other than to sort of maintain things at sort of a low level and build up a tremendous inflationary impact ultimately. Right now, the inflation isn't manifesting itself because of the velocity of money is declining. So all this high-powered money that these central banks are jamming in there, it's getting clogged up in the banking system, and individuals are saving their money, and a lot of people don't want to borrow because they're already in over their heads. But if you continue to sort of counteract this by just jamming more and more high-powered money into the system, there will become that moment of recognition that, oh my God, this paper money isn't going to be worth much eventually. So that will change. People will suddenly want to get rid of it. And that's when inflation really picks up. So I think if Obama were to be reelected, there wouldn't be any real attempt to address the problems. There is a problem they're going to both have to face. This is this fiscal cliff everybody talks about. They kicked the can down the road at the time of the debt limit agreement back in 2011, that they wouldn't do anything substantive on either tax hikes or spending cuts until the election was out of the way. Well, here we are. The election is going to be out of the way in a couple of weeks, and then they're going to have to do something. And that's going to be really instructive, what they do. If they actually made a serious attempt to deal with it, I think it would be very depressive for markets, because it would be a very deflationary development. But I think they're both aware of the reality that they're limited in what they can do. So I'm not terribly concerned.
So with the presidential election, whether it's Romney or Obama that takes office, can you tell me if you think what kind of solutions they might have towards fixing this debt? Do you have any recommendations for them, John?
Well, it's going to be a very difficult job. And in my blacker moments, I said, I don't know why one of these two guys would want this job. The problem is that I believe that they've reached a point of no return on the budget deficit. I mean, the last number I looked at is the budget deficit itself represents about 50% of the tax revenue. Think about that. And basically, when you get to that, there's never been a situation in history when you reach that stage of profligacy that you can come back from it. Because let's look at this. I mean, the only way you can address the budget deficit seriously is basically cut spending aggressively, raise taxes considerably, and pray that the economic growth accelerates. Well, if you're doing the first two, the last one most assuredly isn't going to happen. So it's going to be a very tough job, and I sort of agree with some people that think we're faced with quantitative easing to infinity, and we're just going to have a paper blitz that will result in some form of rampant inflation before this is over. I do not think there is a solution to the U.S. budget deficit that is the least bit palatable.
And John, thank you for joining me today.
My pleasure.